Hey guys, welcome to Dave Take Finance, and here's another video on venture capital. So let's get started with this video and we'll try to figure out what exactly venture capital is and what are the various features related to this form of financing. Starting with the introduction. Venture capital is a form of financing provided to startups or small businesses at their initial stages by affluent investors, which are also termed as angel investors, the financial entities, and investment banks. So, when the financing is provided to the startups, to the small businesses which are at their very early stage, that financing is known as venture capital. And the investors, which could be either the affluent persons with a lot of amount to be invested, with a lot of fund to be invested, or it could be financial institution, or it could be any investment bank. When these different entities provide this form of financing, we call them as venture capitalist. So this is what in simple terms venture capital means. It is provided to startups or the small businesses. Now, this investment by venture capitalists is provided on the basis of firms' future prospects and growth potential, innovative ideas, and a well defined framework of business planning and execution. Now, see, when we talk about the grown up businesses, when we talk about the businesses which are having a good market capitalization, a good market position, now when those businesses have to look out for financing, they could either go for availing loan from banks, or they could go for issuing shares to the public, or many other options, because they are in the market for a longer period of time, and thus everyone is aware about their performance. They could go for their financial performance over the years and try to analyze whether to invest or not in the business, and a kind of trust is already built up for those businesses which are for longer terms in the market. But when we talk about the startups, the small businesses which are just in its formation stage, what should be the basis for them to get financing from any of the public or the banks? It would be very difficult because they are just at the early stage of their business, and they have yet many years to prove themselves into the market to get that financing. Now, in that condition, venture capital proves to be a lot of support for these businesses, because venture capitals provide funds to these businesses by taking a lot of risk on them. A risk because they are investing in startups businesses which may fail, which may rise, but which may also fail, and the chances of failing is quite higher as compared to the chances of rising. Now, thus it forms involves a lot of risk which the VCs take by investing in these startups. Now, if they are taking such a risk, what is the basis for them? So the basis be the future prospects, the growth potential, the innovative ideas, and a well defined framework of business planning and execution. So what these companies do, these companies provide a framework of their business planning. They show how their business idea is innovative, how it could gain the market, how it could tap the market potential in the coming years. Now, if the VCs, if the venture capitalists would be impressed by the presented idea of the business, they would be ready to invest in it by taking the risk, because they could see the longer term benefits, the higher rate of return in the upcoming years. Now, with that trust, with that hope, these VCs get ready to invest in these firms, in these startups, in these small businesses. Let's have a look at the features. So this financing provided by venture capitalists involves high level of risk, as the firms are startups and new in market, so the related competition is high to break through and build a position. As I already told, that because these are startups, these are small businesses which are right now coming in the market, so this involves a very high level of risk when VCs are providing financing to these firms, because these startups has yet to prove themselves. They would have to break through the competition which is existing in the market. They would have to gain the market share and build a whole lot of capitalization for their firm, and thus they would be able to provide the rate of return to the VCs. Thus it involves a high level of risk. As it involves high risk, the expectation of return on financing is also high. Now, the general basic formula of finance is like if the risk is going on, we expect a higher return. And this also follows over here because when the venture capitalists are providing financing for your firm at such a high level of risk because your firm is just new, obviously they would expect a higher rate of return in upcoming future. They would expect a share of profit in the business, a good share of profit in the business. Now, venture capital is in the form of equity financing where the investor buys stake or share in the ownership of the company, which enables it to share the risk and rewards of the business. So, what in turn venture capitalists are providing financing? So, what in turn they are taking? They are taking the share or the ownership in the company, which would enable it to have some kind of risk and rewards, whatever would be there in the business, the profit or loss, they would be having some part of ownership as in quantifiable in the terms of their stakes, in the terms of their shares which they are holding. Now, that would be a form of equity financing. So let's move and see that the venture capitalists provide supports by guiding and participating actively in the decision making for business and hopes for the success of firm to reap out the benefit of a risky investing. Now, what other than just providing financing, venture capitalists also provide supports by guiding and properly analyzing various steps being taken in the business so that they could help in decision making of the business. And because they are so much involved, they provide a kind of support to these small businesses and try to make them go in a successful path so that they could reap out the benefits, they could reap out a good return out of this risky investing. It involves long-term horizon as the time involved in uncertain which the startup may take to build up a profitable business. Now, because we are talking about startups, we are talking about small businesses, obviously it will take a long time horizon to build up a profitable business, to build up a market reputation, to build up a position in the market, to build up a target audience for it, a target customers for it, and thus there is a long time horizon for which the VCs have to stay in contact and look after whether the business is going well in the longer term of future period or not. Rate of failures and loss of venture capital is quite high, still the expected profit after success of firm makes it lucrative option of investing. So as I already mentioned that the rate of failures and losses in most of the startups and small businesses is quite high because many a times what happens, the idea is not able to survive in the market. There is difference in theory and practicality when the firm is having some kind of idea, but when it actually comes in the business scenario, whether it is able to implement that idea well or not. So that all depends. And thus, the rate of failure gets high because these startups, these small businesses really don't stand up with the tough competition in the market many a times. But still, it is a lucrative option of investing because we have seen many startups being very successful. It's just that how the ideas are being implemented, how the market is being analyzed. So it's like investing in a firm which is having a great future perspective, which is having something innovative, a different idea. Some of the examples of successful startups which were highly valued by VCs are Uber, Flipkart, Xiaomi, Airbnb. So you can see all the big companies' name. Those were the startups which were highly valued by VCs. They raised a lot of funds by venture capitalists. Now let us have a look at the process. Let us have a look at the process, how it works. So it starts with the basic idea generation, which is involving the growth potential and innovation. So when a business which has to raise funds from venture capitalists, it would present its idea about the business. What would be its business about, where it would be, and how the business is going to be implemented, that whole idea. Now the venture capitalists, the VCs would see whether this idea is having some sort of growth potential, some sort of innovation or not. If they are having a good growth potential, a little bit innovation to survive in the market, then that idea would be expected and would carried out further in the process to understand the business plan. Now let us see what the second stage is, that is business plan, business proposal with detailed projection on future plans, financial framework, competitor analysis, market survey, opportunities and related strategy. So what happens when the VCs are impressed by the idea of the business, they asked the firm to show the business plan, to propose a to give a business proposal with all the detailed projections on what would be their future plans, what would be their financial framework, have they analyzed their competitors, what position they would like to hold in the market, have they tried getting out the market survey to analyze what could be the products review from the customers, and what are the opportunities there and the related strategies. If they have analyzed all the market, what could be their strategy to deal out at every stage. So this is how business proposal is presented to VCs, to the venture capitalist. Now after going through all these business plan, after going through the detailed projection of all the financial, market, competitor, all analysis, the VCs decide whether the business, whether the startup is having a whole lot of potential or not. If they decide that the startup is having a good potential, they further carried out this process as preliminary meeting, which is meeting to discuss various aspects after going through the set plans of business proposal and to decide whether to provide financing or not. So this meeting is discussion after the business plan has been analyzed. So to present the idea whether they are impressed by the business plan or not, this is convinced in this meeting. And if they are impressed, they would talk about providing the financing and what would be what has already impressed and how the business should go about it. All these things would be discussed in the preliminary meeting. Then comes the term sheets agreement, which is agreement to move forward with the related term and conditions of financing. Now, once the meeting has been confirmed about the acceptance of the business proposal, there is an agreement made. Agreement made in set terms and conditions of providing the financing. Like, I am providing you this much of financing, you can raise this much of capital from me. But the thing is, you will have to provide this amount of equity stake or equity shares ownership to me in your business, and this would be my decision making power over there. This would be the share in the profit or loss, whatever happens in the business. This would be the support I would be providing. All these things are set in a terms of agreement between the startup and between the venture capitalist. And finally, the funding is provided to these startups by observing all those potentials, holding meeting, signing the agreement. This is the final stage where the funding is provided. So this is how the whole process works. Now see guys, this was all about this video, venture capital, where we looked at how it is a form of financing provided to the startups or small businesses in its early stage. We looked at various features of venture capital, and then we have gone through the whole process of venture capital, which was started with the idea generation, and the later stage was funding. In between there were many processes involved. So we had a overview, we had an idea about the whole venture capital in a brief. So I hope you liked this video. Thank you for watching. And if you like the video, do like and share, and don't forget to subscribe to my channel, Dev Tech Finance. Thank you for all your support. Thank you all.